Hello and welcome to the Road to Autonomy. The Road to Autonomy is brought to you in part by Stantec Generation AV. Stantec Generation AV combines some of the most experienced AV experts in the industry with the resources of a global engineering firm. Stantec Generation AV provides education, consulting, assessment, and guidance to any industry interested in autonomous vehicles. Learn more at stantec.com. Hello and welcome to the Road to Autonomy. I'm your host, Grayson Brulte. On today's episode, we're absolutely honored to welcome back Dean Foreman, Chief Economist, American Petroleum Institute. Welcome back to the podcast, Dean.
Hey, Grayson. Happy New Year. Thanks again for having me.
Happy New Year to you. And for our listeners here, we're very proud to announce that Dean will be joining us once a quarter to share his insights into the oil markets. He publishes really great data to the American Petroleum Institute. So, Dean, thank you for kicking the first quarter off today. And Dean, we just entered 2023. What is the current state of the oil and natural gas markets?
You know, as we kick off the year, it's always a fair question, right? And as the economy goes, that's what we're going to look for in oil and gas markets. And then we have these geopolitics with Russia, Ukraine, and a global energy shortage, at least for natural gas, that's sitting out there. From a demand perspective, the thing that's been palpable is how resilient demand has been. And we will this week publish our API monthly statistical reports. So we put out monthly estimates based on our survey data 2 months ahead of EIA. We share the survey data, but we're prompt in putting it out. And it shows that demand, U.S. petroleum demand, last month, 20.5 million barrels per day. As a year, for the year as a whole in 2022, it grew by 2.4%. So if we rack up all of the years going back to year 2000, last year was the fourth highest in terms of growth. This is pretty remarkable. And it says that on the heels of the pandemic, $20 trillion worth of economic stimulus has continued to have a pretty positive effect for the economy, despite Fed funds rate hikes, despite concerns about recession, and despite individual sectors that have been under pressure. So interesting times for sure. And the net for this is we see demand that's outpaced supply or production. That's continued. It's been an enduring trend for more than a year now in these data. We see that inventories are at historic lows. This is really important, especially from a strategic petroleum reserve basis. And the production trends for crude oil in the U.S. have kind of moved sideways. So you add that up, and historically, that's a recipe for upward price pressure. So we need to think about, from a policy perspective, how we fix that. But that's the key takeaway for 2023 right now.
It's interesting you said there was a report in the Wall Street Journal recently that 10% of all car sales in 2022 were electric vehicles, but you're sitting here saying that oil demand has grown 2.4%. What's leading to that growth?
Well, we can take this apart in detail, but there is year on year, actually, as of December, less gasoline consumption, lower distillate consumption, which was really a tale of two halves of the year, where trucking markets were super tight in the first half and then loosened in the back half. But part of the reason that happened was air travel picked up again, and a lot of air cargo got clawed back from the trucking sector along with that. So jet fuel was up, right? So, I mean, those are your three major refined products right there. And then there's this big category that kind of falls under the radar. And we call it other oils, but it's a combination of things that go into refining and petrochemicals. So naphtha, gas oil, propane, propylene, these things. And quietly, this has been over 27% of U.S. petroleum demand. Well, that was just killing it still through the end of the year. And you can think through the pandemic that this was a big part of medical plastics, films, packaging, things that go with online retailing and consumer goods in general, right? But these trends have continued to remain strong. And even though we see some so-called fuel switching off of motor fuels, the consumer side of it's remained quite solid. So net, that's where the strength has been coming from.
The story that's never been told. You just told.
Well, it's why we can't overestimate how quickly this can change, because so many of the molecules are embedded in our everyday lives, from materials to the things that we wear, to the phones that we use. Everything has started as oil and gas in some way, shape, or form along the way.
And that's why I'm so excited to have you on here, because you give a really balanced approach to the oil markets and you ground it in economics. And when you ground in economics, you have a really good understanding of the geopolitics that goes into oil. And we all know in the petroleum market, there's a lot of geopolitics there, to say the least.
No doubt.
I want to ask you from a global perspective now, what impact has Russia's war in the Ukraine had on the markets?
Well, it's caused shortages. And for natural gas, because they're almost a fifth of the natural gas supply globally, I mean, it's really important, right? And it's been evident over the last year plus that there has been a global shortage of natural gas where the prices have been multiples internationally of what they've been in the United States. That maximizes the pull for natural gas exports from the United States. Check, we see that happening. And from an oil perspective, and looking out the window today, spot prices are just over $80 a barrel, right? So immediately after Russia's war in Ukraine, they rose over $130 per barrel, right? So we're still down substantially from that. But is there a shortage or isn't there? Is $80 neutral? How do you view that in context with global supply and demand? And the thing that most people don't realize is that from a strategic petroleum reserve perspective or a government-controlled reserve perspective, we had an unprecedented release last year. The U.S. alone was 1 million barrels per day released over the last 6 months of the year. That's 180 million barrels. We drew down the U.S. Strategic Petroleum Reserve by over 30% in the process. I mean, huge drawdown, right? And on top of that, other allied countries, International Energy Agency member countries, released another cumulative or combined 300,000 to 400,000 barrels per day. So round up and call it 1.5 million barrels per day last year. And that's about 1.5% of the global market just coming out of government-controlled reserves. Well, that arguably drove down prices. That's what the U.S. Energy Information Administration, Department of Energy, and the Biden administration have been saying. Well, if that's true, it's also then put off needed investment for new infrastructure, new drilling, and bringing supplies that the world's likely to need. And that's why Saudi Arabia, OPEC, and even the International Energy Agency based in Paris have come out in recent months and said the amount of investment, drilling, and production and spare capacity is not sufficient to meet demand this year. And the official estimates for demand growth this year range between basically 1 million barrels per day, or about 1% of the market, up to 1.7 million barrels per day. The first one is the EIA, the Energy Information Administration's estimate. The second one's from the Paris-based International Energy Agency, or IEA. And the difference between those, which is quite large, is basically a swing between do they expect a continued global shortage of natural gas or not. The IEA does. They're sitting in Paris where they're short gas. And what's been happening is they're seeing more use around the world of diesel generators to produce electricity, especially in Asia, other economies. So that's why you have such a large variance. But either way, 1 to 1.7 million barrels per day of new oil needed this year compared with last year means you have to have a lot of investment queued up, drilling happening around the world to make that supply come to market.
You have to have the drilling because the EIA data further states that global oil demand is expected to reach a record high of 101 million barrels per day. And then I want to take this to the next level because in the API Industry Outlook Q4 2022 report, the following was stated. Energy policymakers have a dilemma with solid oil demand, but the lowest strategic petroleum reserve in nearly 40 years. Little margin for error. Could you talk about this little margin for error here? Because we have a growing demand, a tight market, and a very low strategic petroleum reserve.
Let's review that for a second. 2.4% growth, U.S. petroleum demand in 2022. That's the year as a whole. And we're sitting here now, the Strategic Petroleum Reserve, per DOE's latest data, ended the year at the lowest point since 1983. That's almost the lowest in 40 years, right? And at the same time, if we're looking at that growth and what we had last year, our consumption as a nation compared to 1983 was more than 1/3 higher, more than 33% higher. So policymaker, why are we comfortable with the lowest reserves cushioning the market in almost 40 years when our consumption is 1/3 higher? And if the answer is that it's because I can produce a lot domestically and translate it rapidly into things, you have to ask, how much surplus do you have domestically? And are you willing to ban exports? And if you're not, and if you're going to make commitments internationally to support our allies around the world, then you've got to have a pretty healthy petroleum reserve. And there are two types. There's the Strategic Petroleum Reserve, and then there are commercial holdings, companies, pipeline fill, storage in tanks. and then people who speculate on this as well. But the days of supply, if we look roughly, the days of crude oil supply on the commercial side are, per EIA's estimates, 29 days currently. And if we add the Strategic Petroleum Reserve on top of that, it's more like 57. Historically, these are low. I mean, if you were looking at IEA, International Energy Agency guidance to its member countries, they would tell them to have about 90 days worth of supply, usually from a net import perspective. And you can say, if you're willing to ban exports in the United States, yeah, you got it. You can continue to produce. But if you don't, you're sitting at 57. So, wow, what has happened just in the last year? If we went back a year ago, December, Secretary Granholm actually was proposing doing just that, rebanning crude oil exports, rebanning natural gas exports December a year ago. Fast forward past Russia, Ukraine, all of that's off the table, and it's making promises internationally. But she was, even late last year, still threatening to ban distillate exports, diesel fuel, heating oil from the United States, because the stocks of those were historically low on the East Coast. And this is interesting because we've seen the market work. And to put it in context, East Coast distillate inventories were between 40 and 50% late last year of what they normally are. And if you get a cold winter, that could be a problem. But we went from, in mid-October, having fewer than 25 days of supply left of this nationwide on average, to seeing it zoom back by year end where it was close to 33 days worth of supply. So adding more than a week worth of supply, very close to normal at that point on a nationwide basis. So this is where we get policy disconnects, right? Because if you threaten to ban exports of products to solve one region's problem, that's like using a proverbial shotgun to kill a fly. And just like shotgun scatter, it has a lot of collateral damage that would go for U.S. consumers. So you can imagine, whether we're talking natural gas, refined products, crude oil, if you ban exports where the U.S. is an important supplier, internationally, prices with short supply and an abject shortage on top of Russia, Ukraine, those prices could go even higher. And if you're sitting on the East Coast, how have you historically gotten your mix of supply? Some of it comes from within region, but here's a numeric breakdown for you. Diesel fuel, heating oil, East Coast, up and down the East Coast, consumption's around 1.2 million barrels per day. Only about 1/5 of that, 1/6, is produced by refiners within the region. A good share, historically, a couple 100,000 barrels per day, would come from imports. But because of Russia, Ukraine, you can't get it off of international markets. And the latest trade data, those imports were down 40% year on year. The good news is refiners in the Midwest, they were producing more and sending it to the East Coast. But oops, those aren't pipelines. That's got to go by truck or by rail to get there. And the biggest single source of supply of diesel fuel and heating oil to the East Coast has been coming up the Colonial Pipeline or by ships out of the Gulf Coast to come around. Well, that's your solution, right? So almost 800,000 barrels per day of supply out of that 1.2 million would come from the Gulf Coast and go over. So how do you make sure, if we've got supplies nationwide back to normal for diesel, for heating oil, how do you make sure it gets there? And these are the policy questions, because to do that, you have to have what's called a Jones Act compliant ship. It's got to be U.S. made, U.S. owned, flagged, crewed. That's your Jones Act compliant ship. And those ships are fully utilized and in short supply. So I got an earful at a conference in Houston a couple of months ago where someone was trying to get these Jones Act compliant ships, not now, but out to year 2026, and they can't get them. And politically, nobody wants to mess with the Jones Act. And as API, we're not advocating for that either. But if you found that the East Coast was in a bind with, an Arctic storm that comes through and people need heating oil, that's about the only way you're going to get it there. So you would need a very limited waiver for a short period of time for one product from one region to another. These things can be worked, but that dialogue breaks down politically with the administration, with Secretary Granholm, trying to come up with the targeted fit-for-purpose policy solution that would really work. And we've seen this on the upstream resource development side, access to new leasing on federal lands. When it comes to pipeline infrastructure and expanding it, there's a lot of political rhetoric that goes with it. But when we ground it to truth and just say, look, this is the economy. These are the fuels that go with it. If we're going to keep the economy on track, not have a boiling frog syndrome for American consumers, these are the supplies that are likely to be necessary in coming years. This is how we get there. But there's a lot of noise in the system, and it's been hard to have that dialogue.
It just takes common sense. I have a dear friend of mine says if you want to run for elected office, you have to pass one test. You've had to write a check to somebody before and learn and know how to balance a checkbook. It's common. It's common sense, and it doesn't seem that there's common sense. If there's individuals in the New England region on the East Coast and they're freezing, pass a temporary order and allow the oil to get up there so those individuals don't freeze. It takes common sense, and common sense is not hard, but yet for some people ideologically, it gets really, really hard, and I don't understand it. Mike Wirth, the CEO of Chevron, he came out and in an interview today with CNBC and said the SPR is going to be filled slowly. Well, what you're describing is prices, looks like all projections, this is not API, this is market data, are going to increase. Why would you want to fill it slowly when prices are saying that it's going to go up? If I'm a consumer, something's on sale for say a week or 2 weeks, I'm going to buy it. I don't want to wait 2 weeks until it goes back to full price. It goes back to common sense.
Grayson, you hit a really good point, because this is actually quite a policy quandary, and it's so timely right now, because let's say we just described earlier that we've been releasing 1 million barrels per day over the last 6 months out of the Strategic Petroleum Reserve. If you wanted to fill it at the same pace, at the same time that the global market would be short, that doesn't have production outstripping demand. In fact, demand, it's just the opposite, right? We've been drawing down these inventories last year. So if you want to suddenly refill or replenish government-controlled reserves on top of the market already being short, that's a problem. And that would add to demand that's then crowding out and competing against consumer demand for the fuels they need at a time that price inflation is already high. But if you refill it at a measured pace, instead of 1 million barrels per day, but let's say it's 100,000 barrels per day, making up numbers here, then that's kind of lost in the rounding of the variation of what global markets see, as long as you're not drawing it down further. But when we're sitting at north of 300 million barrels, if we get down to, for domestic purposes, the DOE's authority to continue to release for domestic purposes caps out. Like, there's no authority to release unless it's an emergency. If the SPR goes under, I think the number's like 254 million barrels, something like that. And if they had continued last year's pace into this year, and the sales stopped in December with the last 15 million barrels being delivered, that limit would have been hit by March. We would have hit that at the end of the first quarter here. So that tells you it is a razor-thin margin. And historically, when markets have, just like in the upstream, the resource development side, we talk about spare capacity. One of the market indicators people watch is how much spare production capacity the OPEC nations have, right? And Saudi Arabia usually, or historically, has had the gist of that. But markets that have a cushion historically don't get rocked by geopolitical events, regional disruptions, whatever it is. And I can't tell you what will happen this year. If it's more Russia-Ukraine, if it's nuclear scaremongering somewhere around the world, if it's China-Taiwan. I mean, there are geopolitical scenarios. And then there's just something as simple as what we actually saw in September 2019 of a Houthi missile taking out a refining complex in Abqaiq, Saudi Arabia, right? That, for a short period, took close to 5 million barrels per day physically offline. Anything like that, if that same event happened today and you took another 5 million barrels per day offline on top of losing Russian volumes, and Russian production, to be clear, is about flat with what it was before the conflict started. But the official projections are that they will lose 1.5 million barrels per day of production this year. And then there's a price cap or sanction proposal that was implemented on Russia by Janet Yellen and Treasury, together with other nations, that took effect for crude oil last month in December and takes effect for refined products next month in February. And some consultants have estimated that that could remove 1.5 million barrels per day of supply from the market. And by the way, we haven't talked about what OPEC's doing, but effective in November, they cut their supplier output by 2 million barrels per day. So you see where I'm headed, right? You already have demand on a solid economy, solid demand that's been outpacing supply. You've got now historically low inventories. OPEC has cut. You've sanctioned Russia where you're losing volumes there. And you have uncertainty about where this can go. So It's a series of nested challenges where policymakers have to just kind of cut through it and see it for what it is. And if you have a market cushion, the probability of being able to ride the storm, whatever may come, is statistically higher. So that's where we stand.
Then let's this is fun. Let's throw another ingredient into the blender here. Weather. Europe so far has had a mild winter, but we're in January, February. We could have a storm in March that could wreak havoc and get very cold. If Europe somehow turns cold this winter, then what's going to happen to the market?
So the relatively warm winter so far across the Northern Hemisphere has shifted natural gas prices down tremendously, right? So it wasn't that many weeks and months ago that we were, in fact, just a few months ago, we saw European prices spike for natural gas as high as $100 per million BTU. To be clear, multiply by almost 6, that's close to $600 per barrel oil or energy equivalent oil, right? And now it's back into the $20 per million BTU range. U.S. prices have fallen by more than half with good supply to less than $4 per million BTU. The outlook, if you stay with moderate weather, is decent for making it through, muddling through this winter. The question then becomes really next winter. Now, if it got cold suddenly, there's a good chance that they could still muddle through. No guarantees on that, but at least the storage levels are sufficient. The problem is with the loss of Russian gas production. That was your main source of fill for European gas storage coming into this year, and it doesn't exist. And the pipelines, Nord Stream 1 and 2 pipelines, have been damaged now. So you're not going to refill next year based on those. And without that, it's not clear what Europe can do for gas supplies coming into next year. And by the way, we've seen more substitution in terms of U.S. gas exports. Historically, we've seen maybe 30 or 40% of our gas, liquefied natural gas exports out of the U.S. go to Europe. Last year, it was over 70%. And it wasn't just cargoes that were destined for Europe. It might have been a cargo that was destined for China, but the Chinese were willing to redirect it economically and send it to the market that needed it the most. So this is a fundamental shift in the way global gas markets have been working as well, because it didn't used to be that flexible. That helps. And that means that U.S. LNG exports have an important role to play in coming years in helping solve both European and global gas challenges, help lower emissions in the process, help keep coal from growing in the power sector in Asia. There's an environmental story that goes with a lot of the progress to be made there. But the only way this does not become a boiling frog syndrome for American consumers is if U.S. gas production can grow to keep pace with those global needs.
Before we get into U.S. gas production, I want to ask you, there's the old saying, we've heard it from kids, everybody's read, the tortoise and the hare, slow and steady wins the race. You understand markets, I understand markets, individuals that are in charge, hopefully they understand markets. If not, you go on a Bloomberg terminal and understand, okay, if we take 10,000 barrels a day off there, 50,000 barrels a day, 100,000 barrels a day off the market, why don't they start slowly nibbling away to build up storage reserves without having an impact on the market?
Well, they may. And I think that's the debate that they have to have. What's happened, and the Department of Energy 2 weeks ago put out a notice saying they were going to postpone refilling the SPR. And the reason that was is if you go back to late last year, they had put out basically an RFP or a price proposal saying, I'd like to buy barrels back for the SPR, but I'd like it to happen between a range of $67 to $72 per barrel. That's what the Department of Energy was willing to pay. And at the time, the prices were in the high $70 per barrel range. The futures markets, even going out a year, were not down there. So ask yourself, okay, who's going to take that deal? If the market prices are up here, why would I commit unless I personally expect the prices to go lower and see the futures markets go under that point? Why would I expect to be able to fill those orders at that point? And they didn't get acceptable proposals, hence it's been kicked down the road here.
To the next Congress, right? I mean, I don't know any other way to describe it to you. Everything in the global markets, it gets denominated in the U.S. dollar. 2022, we saw a strong U.S. dollar. The U.S. dollar rose 6.23%. We're in 2023. Economists are starting to talk about a potential weak dollar. If the dollar gets weaker, what will the impact have on the natural and oil gas markets?
Okay, great question. Let's rewind and educate a little bit on this because the dollar hit an all-time high last year. And in my view, the single largest factor that drove oil prices down in the latter half of last year, it really starts with the Fed funds rate hikes that forced financial markets suddenly to price in a recession, to price in lower growth expectations. And the main thing that affects a currency's strength or weakness in the long run, it's price inflation, one economy relative to another. But in the short run, if my interest rate is higher than what it is in Europe or Japan, I can borrow in Japan very cost effectively, translate the yen into dollars. I can even hedge that foreign exchange risk, but then come to the United States and earn a positive real rate of return just investing in treasury securities at that point, right? That's the so-called carry trade or the term for it. And hot money chasing different interest rates around the world is your main pulse of what's going to drive the dollar stronger or weaker here. Now, the consensus expectations from Bloomberg right now are that the US dollar will recede by, call it 3% this year on average. It's done a lot off of these pretty high levels. They're baking in the fact that the consensus expects at least, and the Fed has signaled a couple more rate hikes earlier this year. So the Fed's out ahead of other economies. Other economies have to step up with their own rate hikes to prevent their currency from depreciating in real terms there. China has tried to depreciate its currency and actually wants to stimulate export-led growth. So that's another dynamic on the side there. So the other headlines in the last 2 weeks vis-a-vis China, Russia, Indonesia, and a few other, India as well, you're seeing pressure to trade more oil, more commodities in local currencies, be it rupee, Chinese currency, Indonesian currency. As that happens, on the margin, you're seeing more trade of commodities shift off of the US dollar. I don't think that's going to have a large impact in structurally changing the system immediately, but it's sort of death by a thousand needles over time because the US dollar has a special status in the world. The reason the US can run twin budget deficits federally and trade deficits, record trade deficit last year, the reason that can happen is that the US currency is sort of the currency of last resort around the world. And the Bank for International Settlements has done some interesting work on this recently, showing how the transition to digital, central bank-backed digital currencies. So we're not talking about Bitcoin and Ethereum and Dogecoin. Central banks that shift this, that changes how currencies will trade, how commodities will trade in those currencies, and ultimately then what kind of leverage you have over your foreign exchange rate. So look, these tee up, I think, longer-term structural issues for monetary systems around the world. The instant impact of seeing the dollar if the dollar, per the consensus expectations, weakens marginally, that's not going to move the needle a lot. But keep in mind, historically, there is a strong inverse relationship between commodity prices, oil in particular, and the US dollar's strength. So as the dollar's been stronger, that's pushed prices down. And it's not that one really causes the other, it's that they respond to the same underlying economic fundamentals. So just like earlier, we were talking about pricing in a recession, it's risk on, risk off. Oil traded as a financial asset, risk on. Raises interest rates, price in a recession, risk off, and these things come down. And as they come down, if it's not a flight to safety in the dollar, if other economies start normalizing, some air comes back out of the US dollar directionally based on historical relationships, that should take some air back out of the commodity prices as well.
Does air go back in the commodity prices with the reopening of China? President Xi wanting stimulus. He's basically, China is not going to see a recession in his eyes, and they'll just keep stimulating until we can get growth. Their economy grew 3% last year. Don't know how. Not saying the data is real, but that's what the Nikkei said this morning.
That's the report, and I think the consensus expectations were just fractionally above that. It's important that for this year, the consensus view is that, and you've seen some projections over 6%. I think most of them are between 5.5 and 6. So higher than what we saw last year. The knee-jerk reaction in financial markets this morning has been, concern about China. But last week, it was just the opposite. It was that people were concerned that China was actually going to reopen. And despite, with the easing on zero COVID policies, despite continued cases that might they could outperform for this year. So the sentiment financial market wise has swung back and forth. The thing to keep in mind on this is that, as the economy overall grows, that's where we're going to see commodity demand, oil demand in particular. So it is important net to get it about right. And the consensus view hasn't missed it much on average here. I mean, we've continued to see consensus views drop with the rate increases late last year. And then the way I build this up for 200 countries individually around the world, look at each one and then put the world together for a comprehensive snapshot. When you look in November last year, the world expectation, Bloomberg Economic Consensus, World Bank, IMF, all kind of coalesced for this year around 2.5% growth on a market exchange rate basis. 2.5% growth is close to long-term historical average growth. It's not great. It's not bad. Get to December, after the IMF has updated its outlook, and there's a lot of groupthink at this point where other forecasters now follow the official view. A lot of downgrades happen. And now, as of December, what we publish in our API industry outlook shows global growth that drops to like 1.8% year on year, 1.7 to 1.8. It's in that range. So more than 0.5% down just based on groupthink, pricing and rate expectations and worries at year end. And that kind of has a tendency to overshoot on the downside. So now we come into this year and you're thinking, well, what's the balanced set of risks for the economic outlook based on where the consensus has gone? And so many sources sandbagged their forecasts late last year that what you're looking at this year doesn't actually, even if China's, Grayson, only at 3% this year, doesn't have a lot of downside risk because it's kind of already baked in. So the risk actually is that China could outperform based on relatively low expectations coming into this year. And it wouldn't take a lot based on having lowered it to that extent. The official views, if you're looking at IMF's latest view, they brought it down a little bit, but it's still close to that 2.5% compared to where it was. The World Bank has come down a little bit recently, but again, still stronger than the 1.7 and 8 numbers that I've factored in from the Bloomberg consensus. So this is a lot of detail and maybe more than your audience wants. But when we take this apart from the ground up and really try to build it up and understand what we're looking at, $20 trillion of stimulus can't be wrong. I mean, that has a lot of momentum that goes with it. And we can talk about everything from where American households stand budget-wise to what's happening with auto loan delinquencies and defaults. You have lots of little indicators and say, there are a lot of reasons why this is holding together. Consumers are under duress and they're making some hard choices, but we're not seeing the defaults pick up despite high price inflation. People are finding a way, by and large, to muddle through. That's what we're kind of seeing in the consumption data. And that reinforces that economic growth overall, when 70% of US GDP growth is consumption related, that's where your important trend will come from.
Do you think that US consumers or global consumers are confused? I'll give you two examples that could lead to the confusion. Goldman Sachs is projecting a recession chance in the United States at 35%. The Bloomberg consensus is at 65%. That's a swing of 30%. That's enough to change a household budget.
Absolutely. And, that probability also varies depending upon when you ask and how recent your survey and who you ask on top of it. The University of Michigan's Consumer Sentiment Index is probably your most reliable indicator of how consumers feel. And starting late last year, it dropped to some historic lows, and then it bounced up off of those. And in the last couple of months, it's still at historically weak levels, but it's off of the really stratospherically weak expectations. And we went through a point last fall where American consumers, on top of price inflation, were saying that they felt worse about their economic prospects than any point during the pandemic and almost any point since World War II. I mean, put that in perspective. And historically, that index has been a really good leading indicator of where U.S. consumer spending growth would head. So that would say bearish. But yet the numbers, when we look through, and we'll get a beat at the end of this month of what fourth quarter growth was really like. But there is an ADS index that's a high-frequency economic indicator that's published by the Philadelphia Federal Reserve Bank. You can look at that. And that gives you kind of a higher frequency leading edge on where GDP is likely to head. That actually shows a fair amount of growth in the first quarter. So, for these reasons, and The other indicator I'll throw at you is that we at API for the last 4 years have published what we call our distillate economic indicator. So we take diesel supply, demand, trade inventories, some price indicators, and some financial risk spreads, and turn this into an indicator that we've published. And it's been spot on in showing the growth in U.S. industrial production and broader economic activity for 4 years. And it tracks, in the way you create these, you back test it back over decades, right? But it's been really strong, and it's continuing right now, even in our December publication, showing that the industrial side of the U.S. economy is held up. So if these things continue, and the indicators say they could, then we really do have to think not that the sky is falling, that take the politics, the lead up to midterm elections last year, all of that out of the mix, and just ground it to truth in $20 trillion worth of stimulus can't be wrong, right? That it has a carry-on effect that, despite higher rates, is causing some potholes along the way. The thing we want to watch out for is whether those potholes become systemic anywhere in the world. There are going to be some food system issues. There are going to be some debt issues in emerging markets. There are things that we need to watch. But by and large, there's a lot of momentum going into this.
There's a lot of momentum, but I would describe what a consumer's feeling is that, though there's a famous book, A Tale of Two Cities. It was the best of times. It was the worst of times. Depending on what data you're reading, you get the best of times or the worst of times. One thing we know that we're going to see in this quarter, we're going to get a lot of data. We're going to get a lot of input, and hopefully we can get a direction of where things are going. Dean, in your opinion, what are the key trends that the listeners here should watch for in the oil markets in Q1 2023 before we have you back in Q2?
Absolutely. No, thanks. I mean, just to keep it on point and short, we talked about China, that growth path, and what happens with growth broadly is going to be important. Russia, Ukraine, if that resolves in some positive way, that's an upside for alleviating the pressures on energy supplies and prices, and just the opposite if the shortages continue. So that's something to watch. I made reference just now to the potential for systemic risks. Food systems are really important, and this is something where the issue is a pent-up one, because if you were rotating crops between soybeans and corn, you're fine for a year. But if you don't have natural gas-based nitrogen fertilizers for more than a year, you got a problem. And in the United States, it's a wealthy economy. They'll pay, get what they need. It will hold together. But many emerging economies, that doesn't happen. And when I talk to the American Farm Bureau, what they'll tell me is that it varies by crop. But if you were growing corn, for example, if you have to use an organic or manure-based fertilizer instead of a natural gas-based one, for corn, you lose between 40 and 60% of your crop yield. It's that substantial. And if you look at the United Nations tracking now, and you can go to UN's website and look at, they track the trade internationally of fertilizers, and you look at what's normal compared to what they actually got in the last crop year through last June, the whole world lights up in red right now. So there are many emerging economies where, whether it's a debt issue, whether it's a food supply issue, where both an affordability issue and an availability issue, the ability for us to feed 8 billion people, and this is another UN celebration last year, right? By mid-November, they put out the landmark that we had passed 8 billion people on the planet. Well, the reason we can feed 8 billion people is because of productivity across the food and energy sectors. So these are the things that I'm watching for next year, and it'll be interesting to see how it plays out. I'm pretty optimistic that the economy looks like it's stronger than maybe some of the sky is falling articles have suggested. But at the same time, I recognize that there are real risks.
The real risk, productivity could be, is the name of this podcast, The Road to Autonomy, through automation. Automation can increase productivity. We could put automation on farms that could hopefully increase the food supply if they can get the materials they need to make the foods. And Dean, as we look to wrap up this insightful conversation for Q1, what would you like the listeners to take away with them today? There's a lot of stuff you mentioned with the emerging market debt, China, Russia, Ukraine, food supply, but what's the one big thing you'd like the listeners to take away with them today?
Well, I hope out of our conversation, the thing that sticks out is that when you get a holistic indicator, something that's broad enough that reflects all of the fuels together with all of the end uses, and something broad like U.S. petroleum demand having held up for this last year and having grown actually, the issue is that everybody has, as economists, we all have pet indicators, right? So, whether you're looking at retail sales, export trends, you name it, but The error of generalization is taking one thing that only gives a partial view of it and then trying to generalize off of that and say, nope, the whole system's collapsing because of it. And that's not what we're seeing. The notion of observing fuel substitution, observing markets in action with consumers, despite the apparent stress that households are under, they're making positive choices that are enabling them to make this through. So, and I gave the example in the auto sector of not losing the auto, but maybe being delinquent for 60 days on the loan, that kind of thing. And they're hard choices. They're potentially hard times, but the ability to just look through it and understand that we don't want to generalize off of one little thing. We want to make sure that we understand a bigger picture. That's the lesson for 2023, in my view.
Observe the markets because you can learn a lot. You can also learn a lot by reading the API Industry Outlook. Dean, and you do a great job. Dean, for a listener who wants to geek out on one of your reports and learn about the global oil markets, where can they read the report?
Absolutely. So at www.api.org, in the upper right, there's a drop down for a chief economist section, or sometimes it just, depending upon whether it's mobile or computer, just shows up there, chief economist section. The reports I've mentioned, articles I write, a lot of these data freely available.
Economists are cool, as the listeners know. I love economics. I love economists because the future is bright, the future is autonomous, and the future is global markets. Dean, thank you so much for coming on the Road to Autonomy today.
Grayson, thanks so much for having me on again. It's a great way to start the year.
Can't wait to have you back on in Q2.
Sounds great.
Thank you for listening to the Road to Autonomy podcast. If you've enjoyed listening, please rate, review, and subscribe on your favorite podcast platform. Want to get in touch? Follow us on Twitter @Road to Autonomy or email podcast@brulteco.com. The Road to Autonomy is produced by Brulteco Company. The views and opinions expressed on the Road to Autonomy podcast do not necessarily reflect the views and opinions of Brulteco Company. The content discussed on this podcast is for informational purposes only and should not be taken as legal, tax, investment, or business advice.